Okay, so these are the concepts which we are going to learn and many more. So what is an assessment year? So we're going to talk about that. What is the previous year? Okay. What are included in persons? Because the persons are liable to pay tax. So who are included in person? Who is regarded an assessee? Once you have become, assessed by the income tax authorities, so you call the assessee. So we'll learn about more and how we charge income tax. Okay. Then, Nirdi, can you read further? Okay, so we are going to learn all these things. Basically, what is regarded as income under the Income Tax Act, because income is chargeable under the Income Tax Act, you have to pay tax on the income. What is the gross total income? Because a person may be, getting income from various sources. He may be working as a salaried person, or he may be doing business, or he may have some property on which he is earning a rent. So put together, all that income becomes his, gross total income, and we'll talk about that more in detail as we come to that point. What is the total income and how it is computed? Okay, so after gross total income we calculate the total income, and then how it is computed we are going to learn. What is agriculture income? Because in India agriculture income is exempt from tax, so we must understand what is agriculture income. What is the difference between exemption and deduction? So there are certain incomes which are exempt from tax, and there are certain deductions which you get. Like, if you take an insurance policy, then whatever premium you are paying, you get a deduction for that under a section 80C. So exemption is that, like agriculture income is exempt from tax. So all the exemptions are given under section 10 of the Income Tax Act. So almost like all 99%, exemptions are given under section 10, and deductions are basically, under various sections, which starting from section 80. So we are going to learn all that in our journey. Okay, Nirdi, can you go further? So basically, we are going to learn what are capital and revenue receipts. Now, it is only the revenue receipts which are chargeable to tax. Anything which has been received as a capital receipt, we are not going to pay any tax on that. Okay, only revenue receipts like salary, business income, all are revenue receipts. Okay, capital receipt would be like you are getting some money from your, for when you sell an asset, you may get the proceeds. So that will be a capital receipt. So that won't be charged. Only the profit will be charged to tax. Okay. So capital is not, taxable, and we are going to learn more about that as we go along. So it is just a, small explanation at the moment I'm giving, but we will do in full detail. What is a capital and revenue expenditure? Now, it's a revenue expenditure. Like if you're doing business, that is treated as an expense. That can reduce your income tax for that year. But the capital expenditure, like suppose you're buying a plant, equipment, machine, so that will not reduce your income. It is only the depreciation which you are going to charge on plant and equipment and machines, because they have a certain life. Suppose you bought a machine for say 1 crore and the life of the machine is say 10 years. So every year approximately 10 lakh rupees you are going to charge as depreciation, depending upon what kind of a depreciation method you are using. So assuming it's on a straight line method and 10 lakhs is the depreciation per annum, so that is going to reduce your that will reduce your income for the year. Okay, but whereas revenue expenditure are totally allowed as deduction, except few cases. How far the method of accounting is relevant in computing income? So how far the method of accounting is relevant in computing income? Now we all follow accrual concept nowadays. So some entities, they follow cash system. When they record only the revenue when they receive the money, not at the time when they sell. So that is the cash accounting. Whereas when you are doing it on accrual basis, that means whenever you make a sale, even if you have not got the money, you will be showing that as an income. Okay. So how far the method of accounting is relevant in computing income? So we're going to understand. Then we'll go to do some problems, examples to understand all these basic concepts. So now we begin and understanding, everything. Can you read, Nirdi? Okay, now of course these are slides coming from VK Singhania book, so it has been copied like for the tax rates, see Appendix 1, and I have recommended the VK Singhania book for the MBA students, so they had all had the book, so they could see the Appendix 1. But then no problem, I'll be showing what are the tax rates. So assessment year, so there is a concept called previous year and assessment year. Okay, now assessment year means the period starting from 1st of April and ending 31st March of the next year. Now, if you look at, the assessment year 24-25, which is going to commence, which already commenced, in 1st April 2024, and ends on 31st of March 2025. So this was the assessment year. Okay, fine. So now, of course, for you, the relevant would be, now I'm just going to make a change so that I can just share the slides to you now. So I'm just making now a small change here and making it 26. Okay, so 25 and ends on 26. So I've just made a small change here. I'm just going to show you because this slide needed to be amended. I thought I have made the amendment. Now look at this. The assessment year 2025-26 will start from 1st April to 2025 and will end on 31st of March 26. So this year is yet to be started. Okay. Now the corresponding year, which is called the previous year, is basically 24-25. That means started from 1st April 2024 and will end on 31st of March 2025. Now, whatever income I have earned during the previous year will be assessed in the year 2025-26. Okay. So income of the previous year of an assessee is taxed during the next following assessment year at the rate which have been prescribed by the relevant Finance Act. Okay. Now we are going to talk about the Finance Act. So here, so you must know that the current year, which is still in progress, which is the previous year, which is 1st April beginning 2024 and will going to be end on 31st of March 2025. For that, the relevant assessment year is 25-26, which means I need to file my income tax return for this current year, which is running in the next assessment year. Okay. So as we go along, you will understand that. Now, if you look at the Finance Act, recently the Finance Act 2025 was passed in the Parliament. Okay. Which was presented by the Finance Minister and has been passed by both the houses, Lok Sabha and Rajya Sabha, and even the President has approved it or given its nod. So for that, the relevant previous year is 2025-26 and assessment year will be 26-27. Okay. So it is done in advance. So whatever income which I will be earning in the next year, okay, will be taxed according to the rates prescribed in 2025 Finance Act. And the assessment year will be 26-27, which is yet to come. For us, the Finance Act 2025 is not relevant because it will start only from 1st April 2025. Okay, because all the income which I am going to earn in the next year will be taxable in the next year. Okay, but for our learning, the Finance Act 2024 is very relevant. Okay, because this is the previous year. For all the income which I am going to earn in this current year, previous year, financial year, which is called previous year, I will be assessed. That means I have to pay tax. I have to file my return and income tax office is going to assess my return. Okay. Now, similarly, if you go back 1 year back, then Finance Act 2023 was relevant for the previous year, 23-24, and the assessment year was 24-25. So, at the moment, the assessment year is still on for 23-24. Okay. So, now people have all filed the returns for this previous year and they have been assessed. Some refunds have been sent to the assessees, or they have deposited the tax. Okay, and some people have filed a revised return or whatever, so they can do it within the assessment year. Okay, we are going to learn all those things later on. So here, which year is very relevant for us, Mananya? Where we are going to focus? Which act we are going to focus? 2025, 2024, or 2023? Ananya, are you there? Nirdi? No, 2025 is, of course, that has been passed by the parliament, and Nirmala Sitaram. We will be doing Finance Act 2024. So I am asking you which Finance Act is relevant for today's learning. Our whole, subject which we are going to learn and understand with respect to Finance Act 2024. Because the previous year, 2024-25, is still on. It's still not completed. We are almost like 25th, 26th of February. So still a month and few days to go. So whatever I'll be earning in 2024-25, I have to, I have to file the return in 25-26, which will be, July, depending upon what kind of assessee I am. Okay, if I am an individual and not subject to any audit, then I have to file it by the 31st or 30th of July. Okay, so for us, the Finance Act 2024 becomes most relevant. Is that okay, all of you? Pranav, is it clear? And what about, Aditi? Is it clear? Anybody has a doubt, please ask me. Ananya Chopra, are you there? Mananya? Prat? Okay. Pratham? Pratham is missing. Janardhan? Okay, okay. Chokalingam, are you there? I saw Chokalingam. He was present. Anyway, I'm just repeating for all of your this thing out again, if you have any. So, Finance Act 2024, which we are going to focus, not the Finance Act 2025. Of course, I'll be sharing the rates which have been announced by this budget, but that will be only for our understanding. Okay, but all our questions, I mean examples, and questions which will become in your exam, or all of my PPTs will be based on the previous year 2024-25, which will be relevant to Finance Act 2024. Okay, and in the next year, that is 25-26, we are going to be assessed for the whatever income we have earned in the previous year 2024-25. We are going to file the returns in next year. Okay, so what is the previous year? Aditi, can you read? So is it now very clear what we have done earlier? Whatever income we are earning, we are going to earn, will be taxed in the next year. Okay. So this is the previous year, which is currently running, which is 24-25. The year in which the income is earned is known as the previous year, and next year in which the income is taxable is known as assessment year. Okay. Yeah, read further, Aditi. Just read provision illustrated. Okay. I am saying that. Okay. Okay, just hold on. Now, this provision illustration is for the previous year. Of course, I have not changed my slides. Okay, so any income which I have earned in 23-24, which has already gone by, is taxable in the assessment year 24-25, which is currently running at the rates applicable for the assessment year 2024-25. Okay, so I have not changed this slide. I could have changed it, but still it is making sense, isn't it? Okay. Okay, so this is there. Okay, so that means I have changed my slide. The second box is telling you that whatever I am going to earn in the year which is currently running, which is 24-25, will be taxable in the assessment year 25-26 at the rates which are applicable to the assessment year 25-26, which is the finance sec, 24. Okay, fine. Read this. Okay. Now, uniform previous year. Okay, just read this. Now, all the assessees, this is called assessees. All the assessees are required to follow a financial year, April 1st to 31st March, as the previous year. Now, this is basically the assessees need to follow this as the previous year. Now, Aditi, have you ever done income tax? Have you ever studied in your school or college? Okay, in the college. Okay, fine. So, read further. So that means there is one uniform previous year. Okay, this has to be needs to be followed for all sources, whether you're drawing income from salary or business or house property, or made some kind of a capital gain by selling a property. If you have made some income, so everything will be uniform previous year. Okay. Now, this is very important. Like companies, they are supposed to maintain their books of account. Now, companies are free to make the books of account on any year they want. They can make it on a calendar year, they can make it on a financial year, or they can, make it from, the Shara to Diwali or something like that. Many people follow different methods or different years. So you can do so. Okay. So it is not necessary that you should have to maintain your books of account on the basis of financial year. Okay. Let's understand. Read further. Okay, so now I'm just showing you an example. Okay, fine. So look at this example. Suppose this is the accounting year. Okay, in the first column, 2023. This is the calendar year. Okay, it's not starting from, it's starting from April, January, and ending in December. So income as per books is 60,000 rupees. Okay, now January to March, the income was 18,000. In April to December, it was 42,000. Okay. Now in 2024, the guy earned 70,000, and 2025 he earned 90,000. This is the income. Okay. Now the quarter wise breakup is given here. The income in January to March quarter was 18,000. and it was 26,000 in the next year quarter, and then it was 21,000. And April to December, this is first figure is January to March, the next figure is April to December. Okay. Now, if we have to see for the relevant assessment year 2024-25, we have to see the previous year is 23-24. So what we have done is, our income is 68,000 here. How? 42,000 plus 26,000. So April to December and next year January to March will be added. So this will become his income. Even he is maintaining the books on the basis of calendar year, he has to file his income tax return in such a way that it is follows the financial year. Okay. So for assessment year 2025-26, okay. So previous is 24-25, okay. 25 here I should write. So previous year is 24-25. For that, the income would be basically 44,000 plus 21,000. So that will be 65. So here also I think I have added some 2 zeros. So I am just going to make a change. So have a look on this slide and just try to grasp what it is there. Now here what happens is that this guy is maintaining books on the basis of calendar year. But for the income tax purposes, he has to, offer his income for the previous year based on the basis of financial year and not on the basis of the calendar year. So he has to do a bit of a jugglery, and he has to recompute his income for 23-24, which comes to like this, 42,000, which was the calendar year 2023. So he's going to take the income from April to December up to this, and in the next year 24, he is going to pull up January to March income and going to add that, so it will become the income for 23-24. Okay. And similarly, the income for 2025, which is, income for previous year 24-25 will be, 44,000 plus 21,000. So April to December, 9 months and 3 months of the January to March 2025. Okay. So if he adds up, then it will become the income of the previous year 2024-25. Have you all followed? Please have a look. Okay. I'm just going to, remain on the slide for next couple of minutes. So try to understand that. I'm going to share these slides immediately on the WhatsApp so that you can also open along with my this thing. Okay, I'll do it after the 1 o'clock. I'll just share the slides so you can just go through. Then again in the evening we'll have a little bit run through. Is it clear? Nirdi, is there any confusion? Have you followed? You have not followed, isn't it? Huh? No means ki have you followed or not? What is written here? So I'll do a poll, okay? So you're not able to follow, okay? No issues. So what I'm going to do is that just the students who have understood, please say yes on the chat box. Let me see if how many students have understood. Okay, if you have understood, on the chat box say yes. I'm not going to ask any questions, so don't worry about it. Okay? So Ashwin Sikka has followed. Very good, Ashwin. Bhumik Bhatia. Very good. Chokalingam says yes. Who else? Anybody else? So I'm just going to again, Pankaj Kumar says yes. Okay, fine. Shivam Gupta also says yes. So I'm just going to have some more. Dhruvakarsh is saying yes. Okay, so what I'm going to do, I'm going to again take you through. Suryansh is also saying yes. Very good. No issues. I'm just going to. Now, let's go back. Okay. Okay, just, I'll ask someone, maybe I'll ask Srishti Khanna, is there? Srishti, are you there? Okay, just read this uniform previous year. So you better get your throat. Are you having some medicine? Okay, good. So you will be okay, fine. Ashwin, are you there? So your background is noisy. Okay, who else? Now Nirdi, I mean Aditi. Aditi is there, so she was reading. So I'll ask her to continue. Just read this, Aditi. So that means that assessees are required to follow the financial year. Okay, that is 1st April to 31st of March as previous year. So this is firm that the whatever we have earned the income from 1st April to 31st of March will be taxed in the next financial year, which is called the assessment year. But for the all the previous years will always remain as starting from 1st April to 31st of March. Okay. Now it is not necessary that we should maintain our books according to the financial year. Okay. Our books can be on the basis of calendar year also. Okay. Like many, foreign companies, they maintain their books on the basis of calendar year. Okay. So, fine. So let's look at this example. Okay. So here in this example, the accounting year is calendar year. Okay. So what I'm saying is, I'm just saying it is calendar year. I'm just going to add this. So this is the calendar year. Okay, I'm just going to save it. So accounting year is calendar year. Of course, a company can maintain the books of account on the basis of calendar year. So calendar year 2023, calendar year 2024, calendar year 2025. But no, income as per the books, is shown as rupees 60,000, rupees 70,000, and rupees 90,000 for all the three calendar years. Now, what this guy is supposed to do is he has to make a breakup. He has to break his income in such a way that January to March becomes 1/4 income, and April to December, which is a 9 month period, he is going to segregate his income uh, on 3 and 9 months. Okay, fine. So once he has done it, so now we can just see the assessment year. Now look at the assessment year 2024-25. For that, the relevant previous year is 23-24. So that means whatever income he has earned in the financial year 23-24 will be taxed. So now our income is there for 23 and 24. So these are the 12 months and this is the 12 months. So what I do is I pick up the income of April to December calendar year and add 2024 calendar year January to March and make it exactly equal to the financial year. Okay. Similarly, for 2025-26, what I'll be doing, I'll be picking up the 2024 calendar year income, ignore this 26,000 income, just pick up this and add 21,000, the income earned in 2025, which is actually part of the previous year. So, and ignore the rest of the 9 months, and I'm going to simply add up and become the income of the previous year. Is that clear now? Ananya, is it clear? Sikka, you are already clear? Nirdi? So anyway, it is not going to be. I mean, we are not going to talk about this concept. I mean, anymore. I mean, during our journey of understanding income tax. But you must know that. Okay, fine. It was just a learning. That's all. There's no question, nothing, which you have to mug up and understand that. So this is just a concept. We will not be even discussing this concept henceforth. Okay. So is it clear? Okay. Aditi, can you read? Okay. So in case, if you are starting a new business, okay, now you can start your business in any month you want. It's not that it's going to be always from April to March. It will start at April. It can't be. It can be starting at January. It will be starting in March. It can be starting at April, whatever. So in case of a newly set up business or a profession, Or in case of a new source of income, the previous is determined as follows. Okay. Okay, fine. Read this, Aditi. Okay, suppose you start a business on January 1st, 2025. So that means what will be the year? How much year months will be there in the year? Suppose you start a business exactly on 1st of January 2025. So for the first previous year, which is going to be 24, 25, how many months do you have left in that previous year? 3 months. Okay, fine. So, thus, in case of a newly set up business, profession, or a new source of income, the first previous year will be a period of either 12 months because you started your business on the 1st of April 2024, or it can be less than 12 months. Suppose you start your business on 1st of December, then the previous year will be comprising of only 4 months. But it cannot never exceed 12 months. Is it clear to all of you? Nirdi, Ananya, Ashwin, Chokalingam? Okay. So if you start your business, somewhere in the, any part of the month, then from that month till 31st of March will be the total number of, months which will be left for the previous year. So that's as simple as that. Suppose if you start your business on 1st of May, Chokalingam, how many months you will have in the first previous year? Or Mananya? Or Ananya? Huh? Who's, who said 10? अनन्या अगर 1 अप्रैल से शुरू करोगे तो आपका तो सिर्फ अप्रैल ही गया ना तो 11 महीने नहीं होने चाहिए yeah you're right now okay fine chalo let's go ahead Ananya can you read now this okay that means only the first year there will be either a period of 12 years or less than that and thereafter it will be always 12 months okay because you have already started the business so subsequent months will be always 12 years 12 months okay fine read this. So under these circumstances, the rule changes. The rule is that, whatever you earn income in the previous year is going to be assessed in the assessment year. But if you are a person who is going to leave India permanently for a long period of time, then immediately your previous year and assessment will become the same. Similarly, if you are income of a non-resident, you are a non-resident guy, okay, and you are from shipping, then your previous year income and the financial year is the same, okay. Incomes of bodies formed for short duration. Income of the person trying to alienate his assets with a view to avoid payment of tax. So he is going to, dispose of his assets or do something with his assets that they don't, exist at all. So basically to avoid tax. So if that is the situation, then he will be taxed. His assessment year will be same as the previous year. Okay. Or if you have discontinued a business, okay, you are running a business, but you have stopped it, then you will be assessed in the same previous year. Okay, just read this and it will be get clear. Okay, read. Now, in such cases which we have done, like a person who is, leaving India forever, or if a person is trying to, alienate his assets to avoid tax, in that case, his previous year will become his assessment year. Okay, so the previous year will have a double role. It will be the assessment year as well as the previous year. It is just few exceptions. Okay, fine. So I will not go. I mean, this is just a basic concept, nothing more. Okay, read further. Now, all the persons, they are required to pay tax in India. And income tax defines what is a person. Now, person can be an individual, like, you and me. It can be Hindu undivided family, HUF. Okay. Now, I don't know whether you are aware of what is Hindu undivided family, but many of you may be aware. And like, I have an HUF and I am the Karta of the HUF. And my sons and my daughter and my wife, they are all co-partners. That means the property which I inherited from my father becomes automatically a property of HUF. Now, HUF is a separate person. So whatever income I am earning by giving this lecture will not be taxable, will be taxable separately than income which we earn from Hindu undivided family income. Now, the Hindu undivided family income, which is my income, which is coming from, my father when he died. So I inherited a lot of property from him, and I have bought a commercial property. And that commercial property is paying a rent, say, for example, 1 lakh rupees per annum or 1 lakh rupees per month. So now that 12 lakh rupees which I am earning is taxable as an income of HUF. And suppose if I am also earning, say, lakh of rupees or 2 lakh rupees per month, so my 24 lakh rupees income is separately taxable, and my commercial property, which is owned by HUF, is taxed separately, so that they are not combined, and my slab rate will not go up. Okay, so up to a certain number, like up to 4 lakhs in the current assessment year, in the next assessment up to 4 lakhs, the slab rate starts. The tax have to be paid after 4 lakhs, or up to 9 lakhs or 12 lakhs. There is no tax, as Sitaraman said. So, I can get an advantage that I have two, entities in my own house. One I myself, and one my HUF. Okay, have you followed that? What is an HUF? So first of all, if I ask you a question, what is HUF? So we are going to talk about that a little bit more. And what we are going to do is that we are going to, go to a site or go to ChatGPT and ask what is a HUF. Okay. And we are going to end up here only today's session. Okay. And understanding what is an HUF. So how HUF is formed, Ananya? Give me the same example what I was giving, or if you have another, then you can. Co-partners. Yeah. Yeah. No, go ahead, go ahead. Yeah. Increase. Yeah. It is separately taxed, and HUF income is separate. So if I own a property, from my HUF property, and it is earning some income to me, so it will be a separate income. Okay. So now just go to the chat GPT, all of you, and talk about what is HUF. Okay. Fine. Just go and just find out. I'll just give you 2 minutes to go through, or maybe 3 minutes, and somebody is going to share what is an HUF. Okay, Neerdi, Ananya, anyone. Okay, Aditi, Ashwin, anyone. So I'm just giving you 2 minutes to go through. I'm just coming in a minute thing. Okay, and just look at and read that. Okay. So who is going to share? Yeah, yeah. Just go to either Google it or go to ChatGPT and talk about what are the salient features of an HUF. Just I mean, yeah. Just share it. Just share it. Can you share? अच्छा चलो ठीक है चलो. Okay, just say what is written. Okay, good. And anybody else who has just gone through and looked at what kind of information is getting? Pranav, yeah. Okay, good. And what about Nyashi? Have you seen that? Nirdi, is it clear what is an HUF? Okay, so just couple of more minutes, and then we will end up the session. Let me just see if I can just complete this particular slide, this slide only. Okay, and then we just end up the session for the day. So, who are the people who are included? So, individual HUF, a company. Now, company can be registered under the Companies Act 2013. We have a Companies Act in India, so it can be incorporated. A company is something which is incorporated under the Companies Act. A firm, that means the firm may have partners. Like my son, he has two partners, his two friends. So they started a business in Gurgaon. So they are partners who are sharing the profits equally. Okay, so a firm, which is not a company but a firm. Okay, so it is registered under. It may or may not be registered under Partnership Act. Okay, an association of persons or a body of individuals, whether incorporated or not. So even some people can come together for just for a cause. Okay, and do business for some time. Okay, we'll talk about this. What is an association of person? Then a local authority, like the municipal corporation of Delhi or a municipal corporation of Gurgaon or whatever. So these are called local authorities. And every artificial juridical person. That means any person which has been recognized as a person under any law. Okay, so will be still regarded as a assessee. Now let's talk about. Okay, so we'll just finish it. So there are 7 categories of persons eligible to tax under the Act. The aforesaid definition is inclusive but not exhaustive. Therefore, any person not falling in the above mentioned 7 categories may still fall in the 4 corners of the term person. So the income tax has kept it open. It is, of course, they have given 7 categories, but doesn't mean that it ends there. So any person who is not even coming under these 7 categories may still be called person if the law thinks fit. Okay, and they have to pay tax. Now let's do a small question. Okay, just see. Determine the status of following. Delhi University, DCM Limited. Of course, DCM Limited, we know all is company. Okay, so let's see the answer here. Delhi University, it's an artificial judicial person. So it is a law created by a law in India, Delhi University. Okay, which is not a Companies Act, but it is a artificial judicial person. DCM Limited, it's a company which is company registered under the Companies Act. Delhi Municipal Corporation, okay, which is a local authority. A Taxman Publications Private Limited, the people who have written the book on through which I am just made my slides, it's a company, it's a private limited company. Then Lakshmi Commercial Bank Limited, it's also a company. ABC Group Housing Cooperative Society, it is an association of persons. Suppose if a group of people come together and form a society, so they will be called an association of persons. Now, XY and Company, firm of X and Y. So it's a firm. Now, The name is company, but it is not registered under the Companies Act. So there are two partners, X and Y. So they called it XY and Company, and it is a firm of X and Y. So it's a firm. 8. A joint family of X and Mrs. X and their sons A and B. So that means it's a Hindu undivided family. Then finally, X and Y, who are legal heirs of Z. Z died in 1996, and X and Y carry on business without entering into any partnership. So they are called association of persons. Okay. So that's all for the day. So these are examples. So I'll